some of chapter 5 through the PowerPoint just because we are shifting gears completely. So it looks entirely different than what we did, or not entirely. We still have debits and credits and all of that.
Different.
Right? I know, it's like, wait a second, we're not ready for that. So our accounting cycle is still the same. You know, everything we learned as far as journalizing and posting and statements and adjusting and closing entries, all of those still are applicable. But instead of talking about a service industry, we are going to talk about merchandising. Okay, so we're talking about, you know, retail basically, companies that buy goods and sell them for a profit. So they buy them usually wholesale for cheap, you know, and then they mark them up and sell them to us. So obviously this could be everything from your Walmarts and Targets down to like boutique retail places. Again, in this class though, we're going to focus on the corporate accounting. So we are looking probably at larger scale retail, or at least publicly traded corporate retail. So like you could always apply it to like Walmart or Target and places like that. Do it. Oh, this is the PowerPoint. So it's just the chapter 5 PowerPoint. It's under unit 4, chapter 5. Yeah. So I'm not going to hit the whole thing, but again, since it's such a change, I thought it'd be good to hit the highlights, at least go over the changes. Okay. So again, it is different because we're moving from service where we had revenue, right? We sold a service. So we didn't have to keep any inventory accounts, really. We bought assets that helped us to perform our services. We billed our customers. They paid us. Pretty simple. So merchandising isn't just like, oh my gosh, it's so much harder. Manufacturing gets more difficult. There's a lot more to trace in manufacturing. But for merchandising, we're really looking at, we're going to have inventory accounts. So, you know, we're purchasing something. So we have to log that purchase. And then we're going to sell it. So our big changes are we're going to add inventory account, which is an asset, just like, you know, supplies or anything else. We purchase inventory. While we hold it, it's an asset. And then when we sell it, we're going to cost it out. So kind of like supplies, you know, and all of that. And then with your revenue, we're just going to call it sales because we're making sales. So just a few changes in how we account. We're going to use accounts payable and accounts receivable more heavily because, as you probably know, in the real world, most big corporations don't pay cash for inventory, and we don't sell on cash sales very often because usually we're buying large amounts of inventory. I mean, could you think about like Walmart, how much they're buying on a daily basis? Right. You know, they're not pulling out cash for that. You know, they're going to have accounts payable. They're going to owe for it. And so we're just going to look at how that structure changes, invoicing, that sort of thing. Okay. So again, accounts payable, accounts receivable, we've already learned those accounts. We're just looking at, well, most of the time when we buy from big wholesalers, we get discounts. And then we have terms, you know, we owe within 30 days or 60 days. So we're just going to look at those terms and go a little deeper into like accounts receivable, accounts payable. Okay. So again, I'm just going to flip through these pretty quickly. I'm on the financial statements slide just because that's where things kind of change a little bit. You know, when we had a service business, we just took our revenues minus our expenses to get our net income or net loss, or they could call it operating income. Merchandising just adds a separate layer in there. We're going to take sales minus this new account we have called cost of goods sold. Cost of goods sold is an expense account. It's the cost of the inventory that we sold. Cost of goods sold. It's kind of self-explanatory, right? It's the cost to us of the goods we sold. So it's the price we paid for our inventory. So obviously that comes out of our profit, right? So we're going to start with that. We take sales minus cost of goods sold to get what we call gross profit. That's our profit before we pay our everyday expenses. Okay, so that's the profit just on the merchandise. That's where you'll hear things like profit margins and, you know, all of that really important stuff. Yeah. So sales minus cost of goods sold equal gross profit. From that gross profit, we take out the same expenses we did in service. Wages, supplies, you know, depreciation, anything. Well, not really. Depreciation's not. You get the idea. Well, we do take depreciation out. I'll just keep having this inner dialogue with myself. It's a great day to talk to yourself, right? Right. My husband makes fun of me for that all the time. I just have these conversations. He's like, are you done? Yes. Exactly. Yeah. Maybe I feel a boring moment. So you take your gross profit minus all of those everyday or what we classify as operating expenses. So again, operating expenses are the same as what we dealt with in service. They're really no different. Wages, supplies, insurance, rent, all of that stuff, utilities, all the fun stuff. So really, the main difference is subtracting out the cost of goods sold because we had to pay for the inventory that we're selling. So it's important, we're not going to focus as much on that gross profit. It's good to understand this formula, but in financial accounting and even managerial accounting, we really get into that idea of setting sales prices and getting to target profits and all that fun stuff. But for here, just good to know how it flows.
It's like I've been doing all that, I just ain't been logging.
Okay, gotta log it though, right? So again, I already mentioned this, we sell merchandise. So first we have to purchase it. So we purchase it as inventory, and then we sell it. Sales is our revenue account. So it just has a different name. It still works the same. It's still a credit, it's still increasing our retained earnings and increasing equity. And then the cost of that inventory is cost of goods sold, okay? So sales minus cost of goods sold equal our gross profit. Kind of just talked about all of that. So inventory or merchandise inventory is the account, the asset account, so it increases on the debit side where we log purchases. So when we purchase inventory, we're going to put all of that in our asset inventory as a debit. And then we either credit cash, if we pay cash, or generally accounts payable, okay? Inventory is a current asset, so it's reported on the balance sheet like with supplies and cash and accounts receivable. Again, switching through a lot of these because you can read through them, hitting the highlights. We're going to focus in this class on using what we call perpetual inventory system. What that means is every time we make a sale, we're updating our cost of goods sold, okay? So we're keeping a running amount in that cost of goods sold. It's really probably the easier way to keep track because you don't have to calculate it at the end. So periodic, again, we won't do that. But periodic inventory system, basically you don't track your inventory cost or your cost of goods sold until the end of the period, which causes it might make the front end accounting a little bit easier, but in the end, you have to do more calculations. So when we do perpetual inventory system, it's really easy at the end of the period to calculate like our gross profit because cost of goods sold has an amount in there. We don't have to calculate cost of goods sold. If we were doing periodic inventory, well, one, we would need to do a physical inventory every period to actually calculate cost of goods sold. Are we still going to do physical inventory counts? Sure, right? We have to reconcile, but we don't have to do it just to get our cost of goods sold. So inventory is important. We want to control it. We control who has control over the inventory, because inventory does have this problem in retail. With service, you don't run into that as much. Yeah. But with inventory, I mean, it does tend to get up and walk out on its own. Right?
Isn't the number of dollar amount of shoplifting a year 45 billion?
Wouldn't surprise me a bit. Yeah. It is crazy.
Well, isn't
yeah.
When I was a kid, I had a friend that used to let us go in the good beauty boy and walk out with clothes.
Isn't that crazy?
Yeah.
It's just crazy to
right?
me.
Like I said, like the shrink. I worked at Best Buy, and when it was the small one right here at Crossroads, and our shrink budget. They hit. We were in big deal about the shrink because if we stayed under the budget, then we got a bonus.
Right.
Right.
Yeah.
But they came in the ceiling and stole all the laptops that was locked up. You know what I'm
saying?
Right. I'm like,
yeah.
Wow, you guys are debonair here.
Yeah. People are brazen.
And then just walking out of Walmart with 50-inch TV, just walk in there and put it on the fucking cart.
Roll it out. Yeah, it's how do you even do that? Yeah. But yeah. Yeah.
I'm just saying that they had the cojones to
Yeah,
say, you know
do.
what, I'm just going to
People
put
do.
this on here and act like
Yeah. If we just pretend, no one notices. The people over there sweating and twitching that they're But yeah, it is a common thing with inventory. So we do our best to control it, and we're not going to focus too much on that in this, chapter. We're going to play the sunshine and roses game of what? People don't steal.
Right, we're not gonna do asset management.
But we will learn about that in later accounting courses, a little bit more about, those types of situations. So yeah, inventory shrinkage is a real thing. All retail have to account for it. And that's just, it's one of those fun, when we did adjusting entries, well, that's something we have to adjust for at the end of each year. We basically get a percentage of how much we think is going to be stolen or, damaged. And then we'll deal with this in this chapter though, or just like returned, what if it's like damaged or the wrong color or whatever. So those are all adjusting entries we do to try to estimate. So then we can account for that. And unfortunately, we have to raise our prices a little bit to account for all of those things.
That's what I was going to get to.
Yeah.
Overpriced goods.
But I mean, I guess the consumers drive that. It's the consumer's own fault. Not, every consumer obviously, but unfortunately, we're the ones who drive that. So when we purchase inventory, again, it's just a simple debit to inventory as an asset and a credit to cash. But again, a lot of times we're going to purchase on account, okay? So the only difference that we see now with accounts payable is notice we've put like a company name on it. This is a vendor that we've purchased from. And this will be the same with accounts receivable. Obviously it makes sense. We want to keep track of who we owe and who owes us. So we do keep separate ledgers usually for accounts payable and accounts receivable, just to get a breakdown of who owes us money and who we owe. So we can send out bills and invoices and we'll pay our bills on time. So, but it's the same idea. It's still going in the big accounts payable account. We're just also going to have a separate ledger where we keep track of like who we owe. Makes sense, right? Mm-hmm. We have to know who to pay. So how we get that is through an invoice. Invoice is where it states all of our terms. And again, we're not going to go into major detail. You can read like the chapter, or if you did the little adaptive learning plan, it kind of went through some of that. But you have to, like, accounting department is going to, before they pay the invoice, they're going to make sure to take the packing slip, take the original purchase order, make sure everything lines up and that we received everything and that it was correct before we pay it. So part of that, there's a lot of internal controls, or what we call it, and we'll talk about those more later in other chapters. But before we pay for these things, we have to make sure that our original purchase order matches up with what we received and then what we were billed for. Okay, so that's a process that happens in the accounting department. But this is kind of just a typical invoice that you would see. Alpha Technologies sold to Net Solutions. So we're the buyer, we're Net Solutions. And it has an order date, invoice number, all that fun stuff. It tells us it shipped on January 5th by US Express Trucking. The terms, that's what we're really focused on. So the terms are what determine how we pay and when we pay. Okay, this one says 2/10 and 30. So that's what we're going to focus on here in a minute. The invoice date is January 5th, and we purchased 20 printer fax copiers, all-in-ones at $150 each. So all total, we owe $3,000 to Alpha Technologies. And again, we're going to look at those terms of our invoice. So basically what it means when we talk about those terms is this is like our discount period that we have. So if we pay that invoice within 10 days, we can take a 2% discount. Pretty nice. Otherwise, we have 30 days to pay just the net. That's what that N stands for. Net amount is due within 30 days. Those are pretty typical discount terms, but you could see other terms. You could see like 3%, net 60, or 1%. There's lots of combinations, but always know they list the discount first, and that's like our discount period. So if we pay within 10 days, we get to take a 2% discount. Otherwise, the full 100% is due within 30 days. From experience working in accounting, we take the discount, but we pay it on the 10th day. Bless you. We hold on to our money as long as we possibly can. We can earn interest on it, Then we pay it on the last day, take our 2% discount. And it's dated by the invoice. So if this was like January 5th was the invoice, we would have until the 15th. Most of the time, nowadays we have electronic payments, so we would probably pay it on the 15th by like 2 p.m. or whatever the cutoff is. If we were mailing a check, it would just need to be postmarked by the 15th. So it doesn't have to arrive at them the 15th, but it was always postmarked by the day. Okay. Again, I worked in accounting it was more of a service / manufacturing situation. It was kind of a special situation, but that's what we did. So again, you know, the invoice was dated the 5th. The discount period is the 10 days that we have to take the discount. So to calculate the discount, honestly, the easiest way is they're telling you to take 3,000 and then subtract the 2% discount. You can take 3,000 times 98% because we're paying 98% of it, so you don't have to subtract and multiply, and you're going to get the amount that we're going to pay, the 2,940. And then the credit period is that whole 30 days we have to pay it. Okay, so that's kind of important. They can give us other discounts as well. Like I know when I worked in purchasing, we got discounts based on the volume that we ordered. So the more we ordered, the more discounts, and that would be by dollar amount or by quantity. It depended on the vendor. We're going to do examples, so I'm going to skip through these so we have time. The only other thing to focus on from the purchasing standpoint is we can obviously return things. So we're going to issue them a debit memorandum or a debit memo to say, hey, we're returning this. We want, you know, an allowance on our bill if we haven't paid it, or we want a refund, you know, for either, again, it could be damaged or incorrect merchandise, or it could just be that we misordered and we need to send it back. Okay. So this was a debit memo. We had service network interface cards are being returned, $90, 10 of them for $900 total. Okay. We, on our end, we're the purchaser here. We're just basically doing a reversal entry. So we're saying we're going to debit accounts payable, reduce what we owe, and credit inventory because we're sending some of that inventory back to them. So with purchases, when we're making returns or allowances, we just debit accounts payable and credit inventory. Okay, just a reversal of when we purchase the inventory. So that's kind of nice. And it shows it there. Again, flipping through a lot of this. On the other side of things, so that was all on the purchasing side of things. So we're going to do some examples in a minute on, you know, purchasing inventory and then paying for those purchases. Okay. On the flip side of things, we're both the purchaser and we're a seller, right? Every retail company both purchases and sells. So there's really, this chapter, that's the only thing that gets confusing is you have to think, am I the purchaser or am I the seller, right? Because they do get confusing. So when we are on the sales side of things, again, we're going to recognize revenue as sales. Okay, so when we sell merchandise, we're debiting cash and crediting sales. But again, just like we're probably purchasing on account, we're probably selling on account too. So more likely, we are going to have, which I didn't show, that's okay. We are going to have accounts receivable, you know, and then the customer that we sold to, and then sales. But it's all the same. So when we sell goods, the only thing to remember is every time we make a sale, there's 2 journal entries, okay? We have this journal entry where we're recognizing the revenue, the cash we received or accounts receivable, and sales credited for the amount the customer paid, okay, what we charged them. And then the second entry is recognizing the cost of goods sold, okay? So we have to do first journal entry, sales, we made $1,800. Well, we sold that merchandise for $1,800. We paid $1,200 for it. Okay, so we're going to recognize the cost of that merchandise to us and show that the inventory is gone. So we do that with a debit to cost of goods sold and a credit to inventory. So again, that credit to inventory is showing we moved it out of the asset inventory. It's being moved out, and the cost of goods sold is being debited because it cost us $1,200 to sell it for $1,800. Okay. So on this sale alone, we charged them $1,800 and it cost us $1,200. So we made $600 of that gross profit. So that's going to go to cover all of our other expenses. Okay. So that's kind of the whole point. Again, flipping through a lot of this just to save us time so we can get into examples. If we use credit cards are a great offer to our customers. we treat them as cash sales, especially nowadays where everything electronic funds are so quick. Usually MasterCard, Visa, American Express pay us at the end of the night for those cash sales, so we just treat them as cash sales, okay? Kind of went over that. Just like we were offered purchase discounts, we can offer sales discounts to our customers. It's the same idea. So the invoice, the credit terms, it's all the same idea. The discount period, credit period, as you can see, it's still 2/10 and 30, only we're offering them the discount. So it's kind of, you know, it's a cost to us, you know, when we offer that discount. Okay, and we'll do examples of those. And then just like purchasing, of course, a customer can send things back as well. So on the sales side, this gets a little trickier than on the purchasing side. So we can offer them an allowance, or we can offer them like to send back the merchandise. So it depends on what we do. Like if someone calls us and says, hey, you sent us the wrong stuff, we can either just give them a credit and say, keep the crap. We don't want it back. You know, if it costs more to ship it back, or maybe it's defective, we don't really necessarily want it back, right? So we may let them keep it, and then we're just giving them a credit on their account. That's pretty easy to handle. If they send the merchandise back to us, though, we have to receive it back. So it just gets a little bit trickier. So this is where we create some new accounts that we haven't seen before. We have what's called this customer refunds payable. It is a liability account. So every year at the end of the year, we make an estimate. It's an adjusting entry. Woohoo! We estimate how much of everything we're going to sell is going to be returned. Okay? So we have to do budgets, and we say this is how much we think we're going to sell, and of that, you know, 3% might be returned, or 5%, or whatever. So at the end of the year, we've said, oh, you know, 500,000. We'll say we'll go big. Is going to be returned. So we credited this customer refunds payable at the end of last fiscal year as an adjusting entry, as an estimate. So now when people actually return things throughout the year, we debit that customer refund payable because that liability account is going down. So we estimate it at the end of each year, and then as a credit, because it's a liability account, so it increases on the credit side. And then every time a customer makes a refund, you know, or requests a refund, and we give it to them, it gets debited. Okay. So obviously that's going to be adjusted again at the end of this year. Maybe we have some still in there. We need, you know, but we're not going to worry about those adjusting entries.
So is the money actually set aside just somewhere?
It's in a liability account. So technically, I mean, we hope we have cash. We should have cash reserves to cover those liability accounts. Yeah, technically. So.
I mean, I'm with you with everything.
Yeah.
I'm just was wondering.
Yeah, we would want to have cash reserves going into the year to cover these, you know, possible liabilities.
Otherwise, we really can't see ourselves balancing it out.
Right.
We don't have it.
Exactly. And we do also have to think, though, every time you have a refund, you've had a sale. So you've had cash come in for it.
Mm-hmm.
So in theory, you should be covered. You know what I mean? Because you're getting the cash and then you're basically just handing it back to them. But we would want some reserves to cover, especially at the start of the year, because they could be returning from last year. Technically, it depends on our return policy, obviously. But even 30 days, if they purchased it at Christmas, we return things in January typically, right? You wait until things calm down at Walmart. You don't want to go to Walmart December 26th. If you've ever done that, don't. Or Target. Like, don't do it. Don't do it. So yeah, it is best to have a cash reserve to make sure that we have that. So again, customer refunds payable, we do it as an adjusting entry. We credit that account, and then every time throughout the year that a customer, we give them a refund, it's debited and cash is credited, or their account. If they owe us money, we would just credit their account receivable. So again, it just depends. That's kind of what this is talking about. They may issue us a credit memo where they're saying, okay, we owe you money and we're returning this, so just take it off of our account. And we would do that. If they've already paid their bill, that's when we would issue a cash refund. But it all comes out of that customer refund payable account. That's the end the end story.
So how many people
Could
are
you
in a typical accounting firm, like Paulston's Tax Service? Do you know what I mean? Like,
It depends on the size of the firm, and yeah. This is all handled internally. So this is going to be internal accountants for like Walmart or Target or whatever that are doing these entries. Yeah.
So what if, company sells something,
Mhm.
it returns it, but they have an outstanding balance, so they keep
Mhm.
it, and they resell that same equipment, does that?
Good question. So yeah, we can resell. It depends, what'll happen is, say I ordered the wrong thing and I return it. Then the seller is going to look at, well, if it's in the box and everything's complete, maybe it's still in the wrap or whatever, it's totally resellable at 100% value. Say I return it because something's missing or, it's defective or something like that. Yeah, then we're going to mark it down and sell it.
rollback.
Yeah. So it all depends on the state of the merchandise and how it got damaged. Because obviously, if it was received damaged, then it depends on how it was shipped too. If it was damaged during shipping, we could actually go after the shipping company possibly if we had insurance on it. So it gets a little tricky with all of that. But ultimately, we do try to sell, the goods that are returned to us. So, and if we can't, like my husband, he works in retail. He's a manager at Russell Stover's at the Outlet Mall. Chocolate, they have a no return policy. It's like you can't.
Your husband's a
You can't bite off
chocolatier?
your fudge and wrap it back up.
Exactly, you can't bring that back. So all sales are final. So I think they'll let them do. I think some things, if they're still in the wrapped box, they let them bring in for like store credit within like 5-10 days. Within a very short window. Because it's yeah. So it's different depending on what industry you work in too. So.
When you talk to them.
Yeah, I always have chocolate in my office.
I'm saying,
Good or bad,
I have
right?
no idea. I have probably spent
Vanilla, I'll be there.
$3,000 on like molds.
Yes.
Is that like the same, say like you went to like Lowe's and had ordered like custom made blinds or something like that, and then like the manufacturer actually had a problem, like was the
They
one with
messed
some
up.
problem, yeah, and you're sent like these defective blinds, like does that take, I mean, is that the same thing?
That's where it gets really kind of tricky because sometimes it would depend on the store policy. It's funny you say that. My brother-in-law works at Home Depot. We have a lot of. I'm like, let me tell you all my stories. And they had that happen with like a dryer. Even it wasn't even custom, but it was like an Electrolux dryer, I believe, which usually those are really good. Obviously expensive, and it was the manufacturer's problem. So Lowe's was kind of the go-between, but they couldn't, or Home Depot was the go-between, but their hands were kind of tied. I think eventually he ended up just giving this customer like a full refund because like Electrolux like sent someone out to fix it 3 separate times and it was still broken.
Yeah.
But the manufacturer wouldn't just replace it. So there it would be like, you would probably start with like Lowe's and take it back. And hopefully they would contact the manufacturer and get it fixed for you.
They do something like custom, you can't resell it unless it's like.
Right. Yeah.
Back on the market.
Yeah, they'll try. Usually what they'll do is what they'll do sometimes is they'll go ahead and issue you a refund and reorder it or whatnot. And then they'll get the money back from the manufacturer. And they may try to resell it, yeah, because someone may want. Yeah.
It's out of that full price. It's not.
Yeah.
So can you like,
Replace that part now. Okay.
Yeah, it's good now. It's great.
That's
Refurbished.
a clean part right there.
Yeah.
so when you're doing your books, can you count a double profit on something if it was like?
It wouldn't really be a double profit since they've returned his money. So it would just be basically you'd be if you were able to keep the original blinds and get the money back for them, you're kind of getting like a extra profit though. So yeah, I mean, kind of. It's not really double, but it would be extra. You would make extra off of that. Sometimes And sometimes the manufacturer will do that because it would cost more for us to send the blinds back to them. And so they're just like, just keep it. I mean, I've ran into that when
Yeah.
I've contacted like Amazon and been like, hey, you sent me the wrong product. And they're like, oh, just keep
Keep
that
that one
one.
and we'll send you something.
And I'm like, score. Gotten some good stuff out of that. So yeah, it does. It gets very complex with returns. And so especially when you're dealing with like custom orders, usually if it's custom order, it can't be returned. But if it was a manufacturer problem, then they have to, yeah,
I just didn't
So, like,
know how
well,
it
that's-
worked on, like,
the accounting side of it.
So
Yeah, I
Walmart's
would think
return policy is
Lowe's
good.
would process it as a customer refund, but then they would then try to recoup their money from the blind manufacturer, would be my guess. I think it depends on the store though, yeah.
I'm gonna do my research and find out, but that's probably why Walmart went over to the return policy and just said, hey, you can just come back and give it to us, but we're gonna give you store credit for keeping the money. You're gonna still spend it in here.
Yeah, it's smart to offer store credit,
You know
you
what I
know,
mean,
it
right?
really
Like, I can't-
is.
You know, and I don't know, I just see is all the transactions that they could possibly be doing in a day, you know what I
But
mean?
everybody
Oh, yeah.
still shops at Walmart, even millionaires.
I'm just saying, period. The fact that
Everybody.
they're-
even
Because they'll
famous
take
people.
anything
If
back.
you come in here and you give me your money,
Yeah.
I'm not gonna give it back. I'm gonna give you some goods, something. You know what I'm saying, right?
But I'm okay with that too, because I'm like, I know I'm gonna spend more money there.
Right. So
And
I'm
they
like,
literally take pretty much, if it's in their SKU now, like in the day, back in the day before they had electronic system, you could literally take anything back. It's actually their policy. Like we went to the museum in Arkansas, the Walmart museum,
Yeah.
and that was like Sam Walton's policy was that you accepted anything, like even like old shoes.
Yeah.
They would give them like because he's like the customer's right. It'll make them loyal to you. And now it just has to be in their system. Like they have to be able to scan it into their system. But
Long as it's the same thing in the store, but it's out of more than one put on the card.
right, exactly.
Because,
Yeah.
I mean,
Yeah, if you have a receipt, they usually give you your cash. But yeah, we've gotten random gifts that we didn't want and just took them to Walmart, even though they didn't come from Walmart. And as long as they sell it at one Walmart somewhere in the world, they'll give you credit. Like score. Ways to rob the system of Walmart. They can afford it. That's what we're learning in accounting. They used to cheat Walmart. No.
I mean, I'm just amazed how big their
They
accounting
do.
department
They
has to
really
be.
do. Oh yeah, they have. They're corporate.
That's
It's
what I do in my
really-
suitcase when I go on vacation, I go buy new ones and I bring it right back.
Only needed this for a few days.
I'm not gonna be going to vacation for a couple of
I'll
years.
need this,
Probably
yeah.
look good though right now. while I'm going.
Whatever it takes, right? So the difference again, when we're doing refunds and we're accepting like something back, the way it changes then, if we've sold it and they're sending it back, if we just issue them a memo, again, if we say keep the goods, you know, and or they were incorrect, whatever, that's just this right here, a debit to customer refunds payable and a credit to cash. But if they send it back to us, we have to receive it back into inventory. So we will debit inventory and credit an estimated returns inventory, which is another one of those adjusting entry accounts to, you know, attempt to estimate how much we'll actually have in returns for the year. So these are both estimated adjusting entry accounts, okay? So every time we actually get merchandise back, we're going to credit it to estimated returns inventory. So again, estimated returns inventory, it is a current asset, but again, it's done as adjusting entry at the end of the year. So we're saying of all of the inventory we're going to sell, we assume, you know, this percentage is going to come back to us. So again, you know, depending on why it was returned and what state the merchandise is in, we might sell it for full profit, or we may have to revalue it and sell it for less. So that's something that happens constantly in retail. You know, just like my husband working in chocolate, well, obviously, you know, Halloween's coming up, so they have Halloween candy. Well, once November 1 hits, it gets marked down, and that's when you go buy it. So in the PowerPoint, I just wanted to point out while we're in here, They do have some really good summary slides because sometimes this gets a little tricky, especially with those estimated refunds and everything. So it's kind of helpful. This shows you exactly what to do. Given, you know, if a customer does not return the merchandise, we just give them a refund, whether it was cash or credit, you know, on their account. Or if they do return the merchandise, then these are your journal entries. So those are nice. I mean, to print off, you can just print off specific slides. So you have that one. And then if I keep going, we're not going to talk about freight right now. They have for all of it. So like this one actually is all of your inventory transactions. So these are purchasing inventories. This is showing you the inventory account itself. So you can see everything that happens to the asset account inventory. You know, purchases are debited. If we paid freight, that would be a cost that increases inventory. So it's debited. Customer refund returns are debited. And then on the credit side, if we returned anything, we're going to credit inventory because we're sending it back. And then obviously when we sell it, it gets credited to cost of goods sold. So these are the T accounts of all the new accounts that we've dealt with. So those are helpful. Going off here. And then these are even awesome too because it's showing you from the seller and the buyer different transactions and the journal entries associated with it. You print those off. When you do your homework, you'll have all the blueprint, basically, the foundation. You know, you just have to calculate the figures. But they're great examples. So, you know, I encourage you to print those off. There's about 5-6 slides to print off because there's 2 of these and then the accounts and then the other one with the returns. And that's really helpful. So again, I know that was kind of quick because there's a lot to do with merchandising.
So the highlighted ones are those, why are they highlighted?
They were new accounts that we've added. Yeah. But we do have about 30 minutes, so I think we have time to get through the practice. So go ahead and go out on Canvas. We're in Unit 4 now, Unit 4, Chapter 5, and you should see a Chapter 5 practice. So Chapter 5 practice, let me make sure it's open. I know we had that happen. And it is not open yet, so let me.
I was about to say, I'm running into the same problem a few weeks ago.
Just gonna go ahead and open these last 3. That way, yeah, I should have done that last time.
I think what happens to you is that they close at 2 o'clock.
Well, these don't actually close. It was actually their open date. What happened on those was that they, when I copied it over, it changed all my available dates. Yeah, technology's great. So if you, I know, right? It's like, this is when you want it right now. That's not when I want it. Because it tried to adjust dates based on my new dates. And yeah, it didn't do a very good job. But if you refresh, you should be able to get into it now. Yeah, I love technology, but sometimes it does. It should be the Chapter 5 practice. Yeah, the Chapter 5 practice. But yeah, you should be able to get into it now. If you're in Cengage, it's probably at the one of the very bottom ones because it puts all the practice at the bottom. And I'm recording this so you can go back and. Okay, so the very first one is calculating gross profit. So again, this one's pretty simple. Gross profit is always sales minus cost of goods sold. Okay, so very straightforward. So let's see, we sold merchandise. Oh, we should have the same numbers.
My numbers are the same as yours.
I'm gonna be real with you, I can't see your numbers, so I'm just operating on faith.
It's the same number.
I'm just gonna assume, yes.
I'm just gonna assume.
You know what assuming does now.
Yeah.
But yeah, it should be the same numbers. Okay. So this one, it tells us we sold merchandise $18,300 in cash and $295,700 on account. So we have cash and accounts receivable sales. And then the cost of goods sold is $188,000. So on this one, we just have to calculate our total sales first. We went cash sales plus accounts receivable or on account, okay? And then we just subtract out our cost of goods sold, okay? So we should just be able to take 18,300 plus 295.
314,000.
And should take 18,300 plus the 295,700 minus the 188.
Yeah, I haven't minused it yet.
Oh, okay.
I was just giving us that number.
Okay, gotcha.
126,000.
Yes, 126,000. Very good. So we just take sales minus cost of goods sold. That's always gross profit. Super easy, but important. Very important. The second one, we're actually doing sales first. I think I put these out of order accidentally.
I so hate these things.
And it's not too
It
bad.
always kills me, like, all the test exams is these.
The
Yeah,
journal
but
entries. Okay.
Because you go in thinking something and then it's not on the list, and you're like,
Oh no. Oh, well, hopefully it won't be that bad. So we're looking from the selling side. So we are the seller. We sold merchandise on account for $92,500, and it gives us terms. Again, that means if they pay within 10 days, we give them a 1% discount. Otherwise, the full amount is due within 30 days. And then it tells us the cost of goods sold. So when we sell merchandise, we have two journal entries. We recognize the sale first, so the revenue amount that we made, and then we recognize the cost of the inventory. Well, the only thing that you have to think about, we're going to take that discount off the top, okay? So we're going to take the $92,500, calculate a 1% discount, and that's how much we're going to recognize as sales. So whether we're the buyer or the seller, in Chapter 5, we're always going to take the discount off the top, okay? So again, you could take $92,500 times 1% and then subtract it from $92,500, or make it easier, yeah, take $92,500 times 99%, because we're getting 99% of it, okay? So it just saves you a step. So how much are they going to pay us when they owe us?
91,575.
Very good, 91,575. Okay, so that's how much we're going to receive. That's our profit. So for the sale, I'm going to debit accounts receivable because it's money owed to us, and credit sales. Okay,
oh, did you repeat that?
and debit accounts receivable and credit sales. So it's always the amount minus the discount. So in this case, 91,575. Yeah, debit accounts receivable and credit sales. So that's always how we log a sale. Okay. But again, every time we make a sale, there's two journal entries. So we have to do the cost. Okay. The cost is what we paid. Well, they told us that amount, the $55,500. $55,500. We're going to debit cost of goods sold, and credit inventory. Okay. So a debit to cost of goods sold and a credit to inventory. So again, that's showing the inventory's moving out because we sold it. So we credit the asset inventory, and cost of goods sold gets debited to recognize the price we paid. So every time we have a sale, we could calculate the gross profit just on that sale. Sales minus cost of goods sold. And that would tell us how much we made on, the gross profit we made on just that one sale. Part B just says we receive payment less the discount. All that means is that they're paying us. Okay. Well, if they're paying us, what are we receiving?
91,575.
Cash. Yeah. And it's the 91,575. So cash gets debited 91,575.
Is it 975 or 575?
575.
575.
Yeah, 575. And then what gets credited? Perfect. Accounts receivable, because they paid their bill. So really, that's just a typical journal entry, right? When we've done in the past where a customer pays their bill in full. And then Part C says, well, what happens if we refund them for defective merchandise that was not returned? Well, that's when we have to use that special account, the customer refunds payable, and we're giving them cash. They've already paid their bill, so we're going to give them a cash refund. And they're not sending back the merchandise, so it's just one journal entry. Be credited. Yep, you got it. So we're going to debit customer refunds payable for the $750 and credit cash. And then we'll mail them a check for that amount. So customer refunds payable gets debited and cash gets credited. Again, if they had sent the merchandise back, that's when we would need to debit inventory and credit that estimated inventory returns account to show it coming back to us. So we like it when they don't send it back. We're like, don't send it back. That's another journal entry. Yeah, exactly. We're good. We're good.
Everybody's right. Want to take that piece of bag out? It's another commercial.
That's funny. Good times, right? Yeah. I'm on that one. Okay, so this one is actually an example where we are going to look at both the buyer and the seller side of things. So I wanted to do one of these because it does get a little tricky because we have to remember, are we the buyer, the purchaser, or the seller? So Shore Company sold merchandise to Blue Star on account. So Shore is the seller and Blue Star is the buyer. And we sold it for $112,000. The terms, we didn't really go over freight. I guess we will now. FOB at the shipping point means free on board at the shipping point. What that means when you see FOB shipping point, that means it's free on board at the shipping point. It means yeah. So the buyer is going to pay the shipping. So there's a slide in the PowerPoint that tells you which one is which if you get confused. But FOB means free on board. So if it's free on board at the shipper, then the buyer or the receiver is going to pay the shipping. Okay.
Taking concepts of selling as well as after I have it later tonight. We just talked about this and it's all starting to click a little.
Yay! Yeah, you have it double then, yeah. And so if it's free on board at the destination, free on board destination, that means the seller pays the shipping. So it does matter how we account for it. So basically what that tells me is Blue Star is going to pay for the freight. So Shore Company doesn't have to worry about the freight. So in this case, it says the cost of goods sold, or no, it says Shore paid freight.
Yeah, it does, yeah.
They must have paid the freight and then, okay, I just figured it out. Shore paid the freight up front. We're going to bill Blue Star for it. I'm like, no, Shore doesn't pay it. So yeah, they add that tricky layer in. So Shore paid for the freight and they're going to add that to Blue Star's bill, which is pretty typical. Okay. So Blue Star is the one that's actually paying the total freight charge, but Shore is going to add it to the invoice. Okay. And that just depends. Like freight can be billed by like a third company like FedEx or UPS or something like that. Or, you know, the seller can pay it up front and then basically bill the client for it, which is what we're doing when I read the whole thing. So we're going to look at Shore's entry for the sale, the purchase, and then the payment of the amount due. Okay. So Shore, the first one is doing the sell. So we sold it on account $112,000, but we need to figure out, we have a discount, right? 2/10 and 30. So we need to calculate our discount first. So how much and what would I debit and credit for the sale?
Accounts receivable.
Very good. Accounts receivable gets debited.
Sales.
And sales gets credited. Good. And then we just have to take off the 2% discount, right? It's $112 times 98%.
$1097.60.
Yeah. Very good. So 109,760. 109,760. is the amount minus the discount. So that's how much we're actually going to get paid. Well, again, when we do a sale, there's 2 journal entries, recognizing the sale and then recognizing the cost that we paid. So what's my next journal entry there? You guys got it. Cost of goods sold gets debited. And that's the amount we paid, so the $67,200. And what do I credit? Yep. Inventory. Good job.
Only because I heard you just say it 10 minutes ago.
Hey, at least you were listening. Did I tell you my 11 o'clock class never listens to me?
You see me pull out turn this way like this?
Pretty much. And then like they're emailing me, what do I do? And I'm like, oh my gosh, I said that 10 times in class.
So what you're saying is we're the best accounting class.
You are. You guys listen to me. And we have fun too. It's like it's a
Yeah,
double,
story.
right? They're boring. So if you know anyone in my 11 Tuesday, Thursday, be like, your professor said you suck. Nah, they're a nice group. They're kind of, they don't listen. Some do. Not all of them. Maybe throw it at them. Here.
And that's how you wake them up.
Might do it.
Sugar rush. Bro.
Hey,
Need something,
I
right?
was gonna say, it's better than what my high school teacher did, because at least you need the candy. She took an expo market.
See, now you think you'd get arrested for that.
Yeah,
Or fired
yeah.
if not arrested.
I grew up in the sticks. They don't care.
They don't
about
care,
laws
yeah.
out there.
See, I prefer that. Like, I won't throw markers at anyone, though. Again, no, I'm just kidding. I was told not to do that.
Yeah, no chocolate. Nobody has chalkboard.
I know. The next journal entry is what we're going to do is pay the freight. Well, again, Blue Star is the one that is ultimately responsible for the freight. So we're paying it right now, but we're going to bill them for it. So when they pay the freight, ultimately, do what?
I'm listening
Accounts
to it.
receivable?
Well, yeah, accounts receivable. Yeah, so we're going to debit their account. So we're going to show that they owe for it, but we're going to go ahead and pay it up front.
And then transportation out on the
Oh, and then.
Cash,
okay.
just cash.
Just cash.
Yeah, so it'll be a debit to accounts receivable and a credit to cash because we paid the freight, but we're billing them. So when we send them their invoice, it's going to have the merchandise minus the discount and the freight. And the reason that's separated, well, one, we like it itemized, right, for accounting purposes. But two, we only take the discount off the merchandise. We never want to take a discount off the freight. So we charge them the full freight charge, okay?
They'd be winning.
Yeah. And then the last journal entry is when they pay us. Well, what do they owe us? Yeah, they owe us cash. So we're debiting cash. And how much do they owe us?
109,760 plus the 1,800.
Yeah, very good. They owe us for both, right? Because we billed them for 109,760 plus the freight of 1,800. So we're going to add that together.
111,560.
111,560. Good.
Big man.
Yes. And that's going to be a credit to their account, accounts receivable, since they're paying it. Okay, so we debit cash and we credit accounts receivable for the sale of merchandise plus the freight that we billed them. So 111,560.
Accounts receivable and credit. I thought accounts receivable was when we was getting money.
We are.
Why we credited that?
We credit them to show that they've paid it off. So we debited it when they owed us. So, and then when we credit it, we're debiting cash. So they've paid us the cash. We're receiving the cash now. And we credit their account to show they no longer owe us. So yeah, credit to accounts receivable is basically zeroing out their account balance.
Account with us.
Yes, yeah.
It's their account with us. 'Cause I think that's
So,
what
yeah.
kind of like.
Yeah, they
I
did
was
owe
getting kinda
us.
confused as well, you know what I'm saying?
Yeah, they did owe us and then they paid. So, yeah.
I'm trying to get somebody to pay me 111,560.
Wouldn't that be nice? On the bottom, it wants us to do it from Blue Star's perspective. So Blue Star is the buyer. So they bought merchandise. Well, if they've bought merchandise, what would I debit?
Accounts payable.
Accounts payable.
We're going to credit accounts payable because we owe.
Oh,
So
So cost of
Inventory?
Inventory, yep. Inventory gets debited because we made a purchase, right? We're the buyer, we're Blue Star, we purchased goods. So inventory gets debited and accounts payable
109.
gets credited.
760.
Oh, do the 111,560.
Okay.
The 111,560 because,
Oh, because they paid for shipping.
For the shipping.
yeah, we invoice them for both the merchandise and the freight all together. So that's why on their end, their invoice shows they owe 111,560. And again, the reason for that, we add the freight charge into the inventory because it's a cost of inventory, right? They had to pay 111,560 for that merchandise. So that full amount, the merchandise plus the freight, all gets debited to inventory because that's what they're going to take as their cost, and then they'll market it from there. So basically, they're making the customer pay the freight, you know, which is how the whole circle, the full circle of retail. And then they'll charge you freight to ship it to you.
Yeah.
Unless they have free shipping, and then, you know, I'm all about that. And then the
Then
last,
price was higher before shipping.
it is, but it's like that, you know, the whole concept, the illusion of free shipping. I fall for that. There was a meme out there that was like that. It was like $10 plus $5 of shipping or $15 in free shipping. It's the perception. I'm getting free shipping. We're so dumb. We talk about that a lot with retail and perception, like customer perception. You know, my husband, because I'm an avid Kohl's shopper, and you know, I would never pay full price for anything in there because it's overpriced. But I always have coupons. There's a yeah, I do have Kohl's Cash like all, you know.
So it's actually the same price as everywhere else.
Yeah, like by the time I take all my discounts, you know, but it's the perception, the illusion that I'm like, oh, I'm earning rewards and I got another free $10. And I say, like I say, one time I went in there and I think I only spent like $15, but I had like Kohl's Cash and other rewards and stuff. So they're like, you saved $143.
You didn't pay that $143.
You didn't. There's no way. But that perception, I was like, look, I only spent $20 and I saved $143.
That's how I feel every time I buy Levi's.
Yeah.
They say, you bought these Levi's for $40-something and they're regularly $70-something. I'm like, well, damn,
You
you buy them for $40-something every time.
Right.
Yeah.
I know. And then you have to pay a little bit more, but they're like, but you still saved $24.
Yeah.
Like, no, I didn't.
Yeah.
Yeah. Or the buy one, get one half off.
Yeah.
I'm like, you just made me buy two. I only needed one. They're like, don't you want another item?
Yeah.
It's half off. Yeah. Amen to that. I only do it on things that I was already going to buy too,
Yeah.
or food. But yeah, I'm like, I don't.
Like, you don't even need something. You see, buy one, get one, half off or something like that. And you're like,
Clearance.
I need to buy that ahead of time in case I ever need it. And then you're like, oh, I never needed this. What even did I do?
Yeah, I do that. I'm not gonna lie. I like to shop, so. But I am a bargain shopper.
I try to be.
You have to be, yeah, like in today's, so, which thankfully with the retail declining, the bargains are getting better at least, so find some good deals. So the last journal entry is just them paying their bill. So from their side, if they're paying the bill, we're gonna debit accounts payable and credit cash because we're paying the cash.
And it's still that 111.
Yep, still the 111,560. So debit to accounts payable and a credit to cash showing that we've paid them. So that one didn't have any returns or anything, but it's just a good example from seeing both the seller and the buyer's perspective of the same transaction. Okay. And then we have one more, I believe. On the last one. Two more. Whoops. It's the last one. Oh, multi-step. We may not get to that. I don't think I meant to. Did I mean to? Yeah, I did. Okay, cool. If we don't get to it, I'll post the solution to it so you can see the difference. Actually, you know what? let's skip this one because this one is actually a standard income statement. As you can see where we're doing our total revenues and total expenses, those are the income statements we've done before. Okay, so actually go to the next one, go to that last one, because I want to show you what a multi-step income statement looks like. It looks long, but it's really not that bad. So all it means here when we say multi-step income statement is we're doing that breakdown of our gross profit. So instead of just saying sales minus all the expenses, we're going to go sales minus cost of goods sold to get that gross profit, and then we'll subtract out all of our other expenses. So it's called a multi-step income statement because you're adding in kind of like a subtotal almost, you know, that gross profit. But that's what merchandising companies use, okay? So again, when we're filling it out, the top line, you're always going to start with your revenue, which in this case is sales, okay? And they gave us all the accounts. So for time's sake, we'll make this kind of quick. It's not too long. Yeah, very good. 8,245,000. 8,245 is our sales. And then on the second line, we're going to subtract out our cost of goods sold. Cost of goods sold, which they give us all of these numbers. Is it 5,500,000?
Show like that?
I was about to say that.
5,500,000. And to gross profit, again, it's just sales minus cost of goods sold. So it'd be 2,745,000. 2,745,000. Now the next part, oh no, they break it down. Okay, good. So the next part, we're now, instead of listing every expense separately, they've categorized them as selling expenses and administrative expenses. And they've already done that for you, so you don't have to calculate what's administrative versus what's selling. But just so you kind of know, selling expenses are usually like marketing and like sales salaries and anything that goes along with the sales of the goods, okay? Administrative is going to be all of your utilities and rent and office salaries and things like that. But they've broken it down for us. So I'm going to say selling expenses. Selling expenses are 575,000. 575,000. And then administrative expenses are 435,000. 435,000. So we just have two instead of having them all broken down separately. So then we just add to get our total expenses, which is 1,010,000.
It's a good thing you said add, because for some reason I subtracted.
You
I was like,
subtracted.
that doesn't work right.
Yeah, 1,010,000. And then that next line is going to be what we call income from operations. Income from operations. So we're going to take our gross profit minus our expenses. Gross profit minus expenses.
1,735 and then 30, so 1,735,000.
Very good. 1,735,000. So gross profit minus expenses. And then we always calculate our, or they just gave us our interest expense. But if we had any like tax or anything, income tax expense, this would also be taken out from income from operations. So we're just have interest expense. So interest expense is just listed separately, and it's 15,000. So our net income is just income from operations minus that interest expense.
1,720,000.
Yep, very good. 1,720,000. Again, a full multi-step income statement would show the breakdown in selling and administrative expenses. So under selling expenses, again, you'd see like sales salaries, advertisement, things like that. Any delivery or freight expense. And then administrative would be like your office salaries, rent, other things like that. But that's it in a nutshell. So it says, what is the major advantage? B.
Say that C.
I'm like, what? Yeah, the multi-step income statement shows the relationship of gross profit to sales. So it's the third one. Good. Like, do what? You chose poorly. So again, I would print off those slides that have the summary of the journal transactions. We covered quite a few of them. I don't think we covered when the seller pays the freight, might be, when they actually pay and are responsible for it. But other than that, I think we covered most of the transactions you'll see in Chapter 5. So be working on your Chapter 5 homework, okay? Finish up Project 2 if you haven't finished Project 2. Get that done tonight, and then be working on Chapter 5 homework. So that's all that we have right now until next Wednesday, is just to work on that. So next Wednesday, bring questions over Chapter 5, and we'll do probably more examples and a review. Okay, sound good?
Sounds great.
So do we just submit this or save and exit and then?
You can do whichever. You can save and exit so that way it stays open a little bit better for you, but it won't matter either way.
Okay, great.